Governor Macklem will be pleased to take questions for about 20 minutes. Before asking your question, please state your name and affiliation. We are webcasting this press conference, so please use the wireless microphone, which my colleague will bring to you. We also have some journalists participating remotely today, so we'll do one question in the room first and then turn to the call to try to make sure every outlet gets a chance to ask a question. The Governor will be happy to answer questions in both official languages. Avant de poser une question, prière de vous identifier. Je vous demanderai également d'utiliser le micro sans fil. Libre à vous de poser vos questions dans la langue officielle de votre choix. So we're going to start in the room with John here.
Hi, John Schillebeck with the Telegraph-Journal. You mentioned in your speech today that in the 1970s, two big mistakes were made to tackle problems in the economy and inflation. You said that the Bank of Canada wasn't aggressive enough in imposing measures, but you also mentioned that Ottawa wasn't restrained enough in spending. So right now, is the federal government restrained enough in spending to avoid these problems?
Well, yesterday, obviously, you saw the federal government put out the fall economic statement, and I'm not going to comment on specific fiscal measures, and I'm not going to give a running commentary on federal and provincial economic updates. I don't think that's helpful for the Bank of Canada's independence. It's not really our job, and there's lots of people to comment on fiscal policy. Fiscal policy is appropriately the responsibility of elected governments and ultimately parliaments. The fall economic statement does provide a fiscal update relative to the budget that was earlier in the year. And over the next 2 years, what you see in the fall economic statement is that the budgetary balance is little changed relative to what it was in the budget earlier this year. So what that means, it's not adding or subtracting over that horizon. So from the perspective of monetary policy, the fall economic statement suggests that the government is not adding new or additional inflationary pressures over the next couple of years, which is the critical period over which we will be looking to reduce inflation and get it back to the target.
We'll go next to Brad.
Hi there, Brad Perry with Acadia Broadcasting. You mentioned during your remarks earlier that, in order to be able to reduce the interest rates, we need to wait until we're on a clear path at 2% inflation before making that step. And I mean, that has a lot of Canadians wondering, when do you expect we will be at that point where we'll be able to start lowering those interest rates and getting back to that balanced path?
Well, I'd love to be able to put it on a calendar for Canadians, but I think that that would risk giving a false sense of precision. I think qualitatively, what we can tell Canadians is that we don't need to wait until inflation is back to 2% before we start lowering interest rates. Monetary policy works with a lag. It takes time to work. So you do want to start to anticipate where you do want to anticipate where inflation is going to be. And so when we are confident that inflation is clearly on a path back to 2%, it will be time to start having that discussion about whether to cut interest rates. Right now, look, yesterday's number is good news. It's good news for Canadians. Inflation came down. But you do need to keep in mind we've seen a fair amount of volatility in inflation. It was down actually a little below 3% in June. It went up to 4%. It's come back down. So there is volatility. What we're really looking at is the underlying trend in inflation, and we particularly use our core measures to look at that. And they've been running for the last number of months 3.5 to 4. Yesterday, they came out around 3.5, so they're very much in the lower part of that range. And if you look at 3-month rates of core inflation, which are sort of more indicative of recent experience, that's running around 3. But again, they're volatile, and 1 month is not a trend. So when we see a clear trend that we're clearly going back to 2, it'll be time to start discussing whether it's time to lower interest rates. Right now, really, we're still assessing whether interest rates are high enough. They may be high enough. They may be restrictive enough to get us back to where our 2% target. But getting back to the previous question, the lesson from the 1970s is you don't want to be half-hearted in your efforts to get inflation back to target.
Thanks, and we'll go to Grant.
Thompson with the CBC. You previously said governments were not rowing in the same direction as monetary policy. Does this update start to do this?
Sorry, can you just say the last part again?
Sure. Does this update start to do this? Get governments going in the same direction?
Look, the fact that the budgetary balance so in yesterday's fall economic statement, the budgetary balance for 23-24 and 24-25 is essentially unchanged from what it was in the budget. And that is helpful as we work to get inflation down over, through next year and into 2025. The other thing a couple other things in the fall economic statement, beyond 24-25, there is some additional spending. We will be building that into our outlook, and if there are any other provincial updates, we'll be building that into our outlook, and we'll be publishing a new economic outlook in January that will build that in. The fall economic statement also includes some new fiscal guardrails beyond the near term, and from the perspective of monetary policy, I do think that's helpful.
All right, we're going to go to the call now. I just want to remind people on the call to mute their line if they're not asking a question. So we're going to start with Max Sato from Mace News, followed by Josh, then Randy. So go ahead, Max.
Thank you, Governor. My question is, service prices seem to be sticky for the CPI, but if higher service costs are mostly coming from higher wages, would that be a good thing for households?
Well, if you look at the inflation numbers, you're right that service price inflation is high, 4.6%. Most of that's coming from shelter. Actually, if you take services ex shelter, inflation's only 2.3%. So I think that's what that's suggesting is you're not seeing a great deal of evidence that higher wage growth, so far anyways, is passing through into higher service price inflation. Yeah, I don't think I have much more to add on that.
We'll go to Josh Rubin of the Toronto Star.
So, hi, Governor Macklem. Thanks for taking my question. It's a bit of a two-parter. First, do you think, in retrospect, announcing the conditional pause was a mistake? Because we saw what happened with the real estate markets taking off like that, because people interpret it as rate cuts were just around the corner. And I guess second, would you agree that we're effectively in a conditional pause right now?
Okay, you're right. Two-parter. So on the first part, look, I'm going to let other people judge the wisdom of our monetary policy decisions. Look, my own view is that the pause made a lot of sense. We had raised interest rates from near zero to 4.5% in a very short period of time. It was actually the most rapid tightening of monetary policy in history. It made sense to pause and let those rapid rate increases feed through the economy and assess whether we'd done enough. We paused for 5 months. After that, as we got later in that period, it started to become clear that monetary policy wasn't restrictive enough, and so we raised rates 2 times over the summer, up to 5%. I think, look, there's always going to be a certain amount of uncertainty about how quickly, how strong the traction of monetary policy is going to be, and you want to manage that. We don't want to do more than we have to. We don't want to slow the economy more than we have to. At the same time, we are committed to getting inflation back to the target, and we're prepared to do what's needed. And when it became clear that monetary policy wasn't restrictive enough, we elected to move rates up again. Since you're right, the last two meetings we have held our policy rate at 5%. We are taking it very much one meeting at a time. As I've said previously, monetary policy may be sufficiently restrictive. Interest rates may be high enough to get inflation back to target. Yesterday's number was certainly encouraging, but 1 month CPI is not a trend. We need to see sustained evidence that underlying inflation is coming down to be more confident. If we see inflation back up, if we see underlying inflation is running around 3%, if we see that persists, that is still well above the target. There may be a need for higher interest rates. We're taking it one meeting at a time.
Thanks.
Thank you. We'll go now to Randy Thong Knight from Bloomberg.
Good afternoon, Governor. In the last set of published deliberations, there was mention of a debate between council members on whether the bank should hike or hold. Were you on the side that wanted rates to move higher? And if not, how did you convince the more hawkish members that holding rates steady was the best course of action?
Randy, I was on the side of the consensus. Let me just clarify a little bit your characterization. So, what I would say is that the summary of deliberations it's just a very straight up summary of what we discussed. And when members of the governing council looked forward, some members were of the view that, I think nobody's got a crystal ball. Nobody knows how the data is going to turn out. But some members were of the view that, on the balance of probabilities, they felt the balance of probabilities was more likely that rates would have to go up further than stay where they are to get inflation back to the 2% target. Other members felt, looking forward, monetary policy probably was sufficiently restrictive, and balance of probabilities were that we wouldn't have to raise rates further. Everybody agreed that given the clearer evidence that the economy had slowed, that it had entered a period of slower growth, that growth was likely to be slow for the next few quarters, and this should further relieve price pressures, there was a clear consensus to hold the policy rate at 5%. What do I think, what should you take away from that? I think what you should take away from that is that monetary policy may be sufficiently restrictive to get inflation back to target. There is, understandably, when you're at one of these critical points, some diversity of opinion across the governing council. That's a good thing. That makes sure we're looking at this from different angles. There is a clear consensus that we need to hold, and we'll be taking it one meeting at a time going forward.
So we'll go next to Mark Rundle from the Globe and Mail, followed by Reuters and the Canadian Press. Go ahead, Mark.
Thanks. I want to follow up on your response just then to Randy's question. You said you were on the side of the consensus and then went on to describe the consensus as, hold in the short term. But I guess it seems like the split was between whether interest rates on a balance of probability would be more likely or not. And I'm wondering if you can explain, what do you mean when you say you were on the side of consensus? Is that you were part of the camp arguing that rates would likely remain steady, or in the camp that was arguing rates would likely need to rise?
Mark, I really don't think I have much to add to my previous answer. I think, as I said, the summary of deliberations, it's pretty self-explanatory. It's a straight-up summary of what we discussed. There was a clear consensus to hold, and I think the reasons for that are very clear. The governing council all felt we could be patient, wait for more data. If that data indicates that we need to raise interest rates further to restore price stability, the governing council is prepared to do that. if the data comes in, if inflation keeps coming down, if we see underlying inflationary pressures ease, we probably won't have to raise rates further. The consensus was we should be patient, let that data come in, and take that assessment one meeting at a time.
We'll go next to Steve Schreier from Reuters.
Hi, Governor. Thanks for taking our questions today. I wanted to pick up on a line that's in your speech today. It says, many households have added to their savings despite the rising cost of living. And I was wondering if you could give us any illumination, I guess, as to why people might be saving right now. Are they worried? I guess my thought is, are they worried about renewing their mortgages, and so sort of anticipating kind of double whammy, first inflation and then their mortgage rates going up? They're putting some money back now. Do you have any insight into that?
Well, let me answer that in two parts, and the first part will be more factual, and the second part will be a little more speculative. So the additional savings really goes back to COVID. So during COVID, households couldn't buy many of the services they wanted to buy. They couldn't go on vacation. They couldn't go to a restaurant. And so they didn't spend as much as they normally do. And so they accumulated what economists sometimes called excess savings. They saved more than usual. And as we've come out of COVID, what we've seen is that Canadians' spending patterns have gone back to normal, but they haven't overall spent much of that additional savings that they saved during the dark days of COVID. So that's just, and interestingly, Canadians are somewhat different than Americans in that respect. Americans, like Canadians, did save more during COVID for all the same reasons, but Americans actually have spent most of that additional savings, whereas Canadians have not. As I said, Canadians' spending patterns have gone back to normal, but they haven't dipped in a significant way into that savings. So then the more speculative part is, okay, so why is that? And look, I think there are many different reasons. Some households are paying down debt. Some households have invested the money, and I think you're probably right. I think some households are looking forward, and they're seeing, boy, when my mortgage resets, it's going to cost me a lot more. So I better park some of that money for now, so that I can absorb the higher mortgage costs when my mortgage renews.
We'll go next to Najud.
Hi, Governor.
Hi, Najud.
Your speech talks about inflation being entrenched in the 1970s. But today, we're now at 3.1% for inflation, less than 2 years since you started raising interest rates. So I'm wondering if you still see a risk of inflation becoming entrenched in the Canadian economy.
Well, Jude, as I outlined in the speech, so far longer-term inflation expectations have remained reasonably well anchored on the 2% target, and that certainly is very positive, and I think it reflects confidence, belief that the Bank of Canada is indeed committed to getting inflation back to 2%, and we will do what's necessary to achieve that goal. Shorter-term expectations of inflation have risen. To some extent, that's not surprising. Inflation was very high. In shorter-term inflation expectations, if you look at our surveys, particularly of households, but also of businesses, they are coming down, but they're not coming down as quickly. Well, put it this way, they're above our own forecasts of inflation. So they're coming down, but they're coming down slowly. So that is a source of concern, because behavior is also affected by shorter-term expectations. When you think of people's decisions, they're what people think inflation is going to be over the next year or two matter for those decisions. So that is something we're watching, and one of the signs that we're clearly getting back to 2% is that those shorter-term inflation expectations keep coming down towards 2%. So to get to your question, if we saw that those shorter-term expectations were stalling well above the 2% target, that would be a sign that expectations that inflation is going to stay higher than our target could be starting to get entrenched, and that would certainly be something that would concern us. You know, we are concerned that those inflation expectations are coming down slowly, and so it's something we're watching, and we need to see those keep coming down. But so far, they have been coming down.
All right, we are almost out of time, but we have two more reporters on the line. So we're going to go to Greg Quinn from Market News, followed by Paul Vieira from the Wall Street Journal. Go ahead, Greg.
Hello, Governor. The federal government is formalizing a so-called charter of mortgage lending, which allows a lengthening of amortization and other relief for borrowers in difficulty. Is there a risk that if people keep getting stuck on repaying their loans, it will alter your inflation fight or introduce some other instability in the financial system?
You know, Greg, I don't have much to say on, you know, specific government actions, but, you know, I will say in general terms, you know, households that are, you know, having real difficulty paying their mortgages are not households that are contributing too much to spending in the economy. So, you know, we don't want, monetary policy is never going to work equally across the economy, and equally across all households, but we don't want it to be any more unequal than it has to be. And to the extent that, you know, the people that are, you know, really having difficulty, there's a way for them to work through those difficulties. You know, that's a good thing for everybody.
All right, Paul, go ahead.
Hi, Governor. In the speech, you said excess demand is now gone. I take it then, is spare capacity now building, and how many quarters do you expect spare capacity to build up to a point where you're ready to discuss rate cuts?
Well, on the first part of your question, you know, this was a speech. I spared the readers the long list of indicators that, you know, one looks at when one comes to an assessment as to whether the economy is in excess demand or excess supply. I mean, as we indicated at our last decision, you know, a broad range of indicators suggest that the economy is at least approaching, you know, flipping from excess demand to excess supply. You know, some indicators suggest we're already in modest excess supply. Other indicators suggest there still may be a little of excess demand. I think, and, you know, and since our last decision, the economic data, you know, growth's been pretty weak. The indicators have not been particularly strong. So, you know, we're either approaching or already in a little bit of excess supply. I think it's hard to be super precise about whether it's a small positive or a small negative. But I think, you know, the message in the speech is that, you know, the excess demand that was really contributing to inflation is gone. We do expect to move into excess supply in our own forecast. We've got, you know, the next few quarters growth is quite subdued, well below potential growth. You know, it starts to pick up in our forecast late in 2024. So we will be moving into excess supply in that period, and then as you get into 2025, that excess supply will begin to be absorbed.
All right, that is all the time we have for today. So thank you all for joining, and thank you to the Governor for participating. Have a good day, everyone.
Thanks very much.